one of the things that you have to look at, and when we talk about diversification, is that if you take your money and you don't bet on just one horse, you bet on many different horses across different industries, you basically protect yourself from picking the wrong one. You've got better chance of staying around. However, when you over diversify, you dilute everything so low that you're always winning somewhere and losing somewhere, and the net in is no gain, unless all of that diversification was among dividend stocks. They were paying you good dividends, because then some stocks are going to go up, some are going to go down. You buy those that are in their cycle part down, they call cyclical stocks. And then over time, what your gains are really going to be the dividends that all of these companies are paying. In other words, you might have one stock like IBM going up, another stock like pennies going down because of the economy at a certain time, but they're still both paying you maybe an average of 4% dividends, because that's what's going to happen. One's going to be paying you 8, one's going to be paying you 3. So when the average of the two, depending on how much you have invested in each one, is going to be less than 8 and more than 3. So, your mix makes the big difference. But the truth is, the more variations of stocks you have and the number you have, the less likely you will move up with big gains. But you will have steady gains, okay? And if you lose, let's say one of the stocks you own is Sears, which is already gone. So if you happen to keep Sears longer than you should have, and that's possible, you lose the Sears investment, but you made all the dividends from Sears, which was said was 70% of it. So you really lost 30% of it. Okay. But at the same time, because you didn't put everything in Sears, you had J.C. Penney's that was paying you 5% in 10 years, and you were making 5% on that money. So, but times 10 is 50%. So as long as you didn't put too much or more in one or the other, then the sum net gain would be the dividends. The stock may have gone out, but the sum net gain would have been 70% from one, 50% from the other. If you always put $1,000 in both of them over that same period, you'd have $700 in one and $500 in another. So you'd make $1,200, which replaces the $1,000 you lost. So your net gain would be $200. So that's how some of that works without having to think about it. But you want to be still cautious about it. That's a strategy. Mixing dividends, cyclical movements, and getting some that are having long-term straight-up growth or going on a gradual incline, like a PepsiCo, or maybe like the AMT stock today, or some of the other stocks. But if you're buying cannabis, or if you're buying solar type stocks, or you're buying stocks that are shooting up like Zoom and then coming down and cratering real fast, you run into the situation that those variations, that volatility creates a problem.